This upcoming week is by far the most important week for the stock market and for investors that we are going to see throughout all of 2022. And this week alone will give us enough information, enough data to send the stock market to new lower lows or potentially continue on this rally we have seen over the past week and a half. Now, there is one thing above everything else we're going to talk about here in this video that could send the stock market up in a dramatic way and could actually mark a bottom for the stock market. It's this one simple thing, and we will get into that here in this video. But first things first, what do we have lined up in store for us? And we're going to do this in chronological order, meaning Monday through Friday. First things to expect on Monday, well, you really only have earnings. You don't have any economic data that comes out on Monday. It's kind of like a silent period because we have so many other earnings throughout the rest of the week that are much more important. But some earnings on Monday do include Philips in pre-market, Whirlpool in after hours, as well as Logitech in after hours. None of these companies are going to move the markets in a big way. You really get the big market movers starting on Tuesday. On Tuesday, you have new home sales for June. That comes out at 10 a.m. Richmond Fed Manufacturing Index for July coming out at 10 a.m. and new home sales month over month for June also at 10 a.m. Can't forget to point out the S&P Case-Shiller Home Price Index year over year for May. That does come out at 9 a.m. That was something that did help to crash the markets last time that came out 1 month ago. But let's be honest, that stuff is not going to crash the markets this time around. It could be earnings, and Tuesday morning you get UPS, Coca-Cola, GM, GE, McDonald's, but most importantly in after hours you have Alphabet, Microsoft, Visa, Enphase, Chipotle, Texas Instruments, and Skechers. Obviously, by now, you guys know Alphabet, Microsoft, those are going to be the companies that will move the stock market 1 to 3%, depending on how good their earnings are or potentially how bad their earnings are. We just heard from Snapchat earnings advertisers are slowing down, so it will be very important to see how Google can hold up against something like a Snapchat. If that's happening at Snapchat, is that happening at Google? Something to keep in mind, something that could cause some fear in the stock market. And the reason why this is ultimately so important, because you guys can see right here, this is the weighting of the S&P 500. Over 5% of the total weighting of the S&P 500 is Microsoft alone. Over 3.8% of the S&P weighting is weighted from Google. So that's why these companies are such a big deal. On Wednesday, you have durable goods orders at 8:30 in the morning, retail inventories excluding autos 8:30 in the morning as well, also pending home sales at 10 a.m. Now, this is all going to be somewhat important, but on Wednesday you actually have some bigger earnings as well. You have Facebook earnings and after hours. That is really going to be the one that people pay attention to, but you also have Shopify, Boeing, Spotify, Waste Management, Sherman-Williams, and Kraft Heinz in pre-market on Wednesday. These different earnings will affect different sectors of the economy, but in addition to Facebook earnings and after hours, you have Ford, Qualcomm, Teladoc, Etsy, ServiceNow, and QuantumScape. But the most important thing on Wednesday is actually the Fed. The Fed will be the difference between the stock market hitting newer lows or the stock market continuing on this rally. What we are seeing priced into the bond market is that bond investors are expecting the Fed to even cut rates as soon as mid-2020. So what investors are starting to expect is a Fed pivot and a Fed U-turn. Now, there's an argument for both sides of this. There's an argument for a Fed U-turn just to say, hey guys, we are going to stop raising rates as aggressively right now, and we're going to let families and businesses adjust to these higher rates that have come very, very fast. That's the bullish case. That's the Fed kicking the can down the road, giving the markets a little bit of breathing room, and we could start to get some higher valuations for stocks again. And ultimately, we'll see what happens with the recession and all of that. We'll talk about it later on throughout this video. The bearish case is that inflation is 9.1%. PCE, the metric of inflation the Fed really pays attention to, is still in the 6.5% range. That's 3 times higher than where the Fed wants to get inflation. And people forget, the Fed does not need to protect the markets necessarily, relatively speaking. The 2 mandates the Fed has is stable prices and maximum employment, which they got the employment part. Obviously, stable prices, not so much. So the bearish case is the Fed gives us the same thing that they have given us over the last 6 months or so, and they say, hey guys, we got to keep raising rates. Now, the Fed is expected to raise rates by 75 basis points. About 80% of market participants expect that will happen. About 20%, give or take, of investors expect us to get a 1% rate hike, but that does not look very likely. But even if we get a 75 basis point rate hike, we are still at the neutral level of 2.25 to 2.5%. So that's a little bit more of the bullish case. Potentially the Fed puts their foot on the brake a little bit and slows down. Probably not stop raising rates, but maybe slow down. A lot of people have pointed to the yield curve inversion and what Fed Bullard said about 2 weeks ago, that he takes yield curve inversion very seriously as a signal of pain to come in the economy. Yield curve still being inverted over 20 basis points definitely is not forcing the Fed's hand, but it is going to play a role, and what Fed Jerome Powell says at that press conference at 2:30 will be of the utmost importance. Keep in mind, we actually get the Fed rate decision and the report that comes out at 2 p.m., and then you get Fed Powell at 2:30 p.m. You will see a very violent market reaction based off of what is said, and that could possibly give you a glimpse into what the markets think about the report. But you gotta wait until Fed Powell comes out, and then the reporters ask Fed Powell the questions in which the yield curve will be a topic of discussion, and when the Fed will stop or slow down raising rates will be, I think, the most important thing the markets care about. Now on Thursday, you have likely the second most important thing happening. You have advanced estimates for Q2 GDP coming out at 8:30 in the morning. As you guys can see, that is the bar that is highlighted in red. It's expected to be a high volatility catalyst. And why is this? Because we had a negative 1.6% GDP print for Q1. We are expecting, again, another negative 1.6% print for Q2 GDP, and that would mean we are currently in a Wall Street recession. Now, a technical 2-quarter declining GDP growth does not have to mean the stock market will hit new all-time lows. That's not a 1-to-1 ratio. It's not an exact science. But if you have the Fed that comes out the day before, keep in mind Wednesday is the Fed at 2 o'clock, 2:30 is the press conference. If the Fed comes out and they are reiterating the same thing that they have been doing, which is pushing us to this recession anyways, well, the markets will then start to freak out. They're going to start to say, hey, this is going to be likely a deep recession. And I think the cherry on top will be coming on Thursday, because in after hours, you will have Amazon as well as Apple reporting earnings. And I think without argument, without a question, these are the 2 most important stocks for this earnings season, but for the broad markets that will absolutely move the markets up or down in a very big way depending on their earnings. And the biggest reason for that is the consumer. Yes, these companies are huge. Apple, the second largest company in the world. Yes, they're big companies, but it also gives you a glimpse into consumers and the way that Apple has been acting as of lately. It's up 20% from the lows we just seen a couple of weeks ago, whereas the stock market hasn't even returned half of that. well, you're setting yourself up for a little bit of disappointment, especially as Apple has just came out and joined the tens, if not hundreds of other companies that are reducing hiring, reducing spending, that are starting to see their numbers not look so good. And people are flooding to Apple as a safe haven. If Apple proves it cannot be that safe haven, well, there you have it. That could be the icing on the cake. Oh, but I also cannot forget that Apple controls 7% of the S&P and over 12% of the Nasdaq, and Amazon, which also reports earnings on Thursday, controls about 3.22% of the S&P. So you have 10% of the S&P market weighting, even more than that if you include other stocks, and over 15% of the Nasdaq weighting that is just reporting earnings on Thursday. So that's going to be the majority of what we have for this week. On Friday, you do have a couple earnings, including Abivai and Chevron. These pharmaceutical oil companies are not going to move the markets, and I think by Friday everyone is going to be trying to take a breather and relax a little bit, because we are going to be on data overload, and by then the market will have either made a big move to the upside or a big move to the downside. Now, to conclude this video, the bearish case for this week is, simply put, the Fed comes out the 27th on Wednesday and basically says the same things that they've been saying. Right? Nothing new comes out of the Fed. We get our 75 basis point rate hike. We don't get any new clues to policy going ahead into the future. The next day later, on Thursday, you get advanced estimates for Q2 GDP, which confirms we are in a technical recession. Oh shit, at that point, markets are going to be freaking out a little bit. But add on top of that, if earnings are bad, well, there's your worst case scenario. There's where the stock market, almost 100% guaranteed, will be hitting new lows. But the bullish scenario for this week is if the Fed comes out on Wednesday and they say that they are going to slow down their pace of rate increases. That would be the single most bullish thing. And then on Thursday, we get probably a negative GDP print, but maybe not as negative as what it could have been. Maybe we get a 0.1 or 0.2% negative GDP print. Still would be a technical recession, but it's pretty close, and I think the markets would be able to shrug that off a little bit. And then if earnings are not as bad as what people fear, and unfortunately it's going to come down to Apple, Google, Amazon, Facebook, the companies that report from Wednesday to Thursday. So that is going to be all for this video. Leave your thoughts down below. Are you bullish? Are you bearish? Why? Give me your thesis like I gave you mine. Thank you guys for doing that. Hit the like button, subscribe to the channel, all of that good stuff. I will see you guys in the next one.